guest, Naval Bir Kumar, MD and CEO at IDFC Mutual Fund. Naval, hi, morning. 10% is what the Indian market has lost in the last financial year. Do you think this year it would be much more than that, or do you think equities could surprise us on the upside?
I think this is going to be a range-bound market. Fundamentally, the economy is not looking strong. It's looking a little fragile given the high fiscal deficit, slowing investment spend. It's buoyed up by consumption flows and a stronger rural economy. And I think the driver in terms of where the market ends a year from now is going to be on global capital flows. The first 3 months of the calendar year has surprised everybody through the large flows that came in through Jan, Feb and March. They seem to have slowed over the last 15-20 days, and they seem to be pausing, which gives us a belief that the markets are going to be range bound. Whenever they become excessively cheap, you'll get a flood of money that comes in and buys, and at other points of time you will get people who will profit take when markets become relatively well priced. And the rupee for most of this, at least the next 6 months, will remain weak and will need to be supported by the Reserve Bank of India, and they've been doing so month on month for the last 5 months now. So I think that's the environment. I think range-bound markets, very hard to predict where it will be a year from now, dependent completely on flows.
Right, morning, Naval. Nikunj Dalmia also joining in. So Naval, if you are of the view that in the near term there are couple of macro headwinds, do you think Indian markets or Indian equities can do well despite a bad macro environment?
I think selectively, yes. I think I believe the next 12 months is an alpha period. It's not a beta period. I think indices remain range bound, but it's a story of picking individual stocks, picking themes in the Indian economy, picking trends, and there are a number of trends that look very positive over the next 12 to 36 months. And if you can play them well, if you can play them with the right stocks, you can make a lot of money in Indian equities. But you will not make it, in my view, by playing beta, by playing the indices.
So Naval, which sectors do you think would surprise us on the upside?
One part of the investment economy where we believe consolidation is occurring, there's some level of debt restructuring, and we are being able to recognize winners in the investment economy that will lead the next investment cycle, which will most probably commence 2 years from now as we start the next phase of infrastructure build out. But if you can pick those winners, and they are exceedingly cheaply priced today, then you could build yourself a basis of a very good investment portfolio that will do well over the next 5 years. The consumption economy continues to look good. Within financials, we like the retail financial theme. We think the corporate balance sheets are fairly over leveraged, but household sector is under leveraged, and employment remains strong in the Indian economy. Income growth remains positive, and hence we believe focus over the next 12 to 24 months will shift towards retail finance. And there are clearly some financial services firms which are better poised to capture that than others. So playing them will be, we think, is a good idea. We believe that consumption is on a rise, and a large part of cement consumption goes into roads and buildings. And we believe in India, supply creates demand. So if a significant block of low-cost housing is made available, I think there's sufficient demand to come and meet it. And we think that the environment is building up where real estate prices will tend to peak and in fact subside a little bit, and focus will be not on building land banks by real estate developers, but by building properties that they can sell. So you will see a lot more transaction over the next 36 months. A lot of real estate projects that are poised will restart, and restart at much more reasonable valuations. Focus will be on sales rather than on speculation on holding large tracts of land, and we think that is a great fillip to the cement sector. In terms of banking, we like that part of banking that's focused on the retail sector. We don't like that part of banking, or we are neutral on that part of banking which has got large amounts of capital loans on its book, because we think we believe that the economy will go through a period of debt restructuring, not necessarily very high NPAs, but there will be debt restructuring that will sort of cap profits for those stocks.
Now, well, what about global commodities? You're bullish on cement, which is not quite a commodity.
Global commodities are, I think, being held up to some extent by demand, but to a large extent by large capital flows and speculation. I don't really have a strong view on global commodities, but I believe that they need to correct a little bit, given global growth where it stands today. There's a clear lack of linkage between those two. In terms of local, we clearly believe there's a lot more strength in the Indian economy, and we would love to play the local themes that are evolving strongly. And like I said, India is a growing economy, lots of positives, lots of advantages. I think we are all completely bogged down by the politics in the country currently and the lack of policy initiative, which is stalling the next phase of growth, especially in the investment economy. But having said that, we believe investment cycles occur over periods of 5 years, and there is thereafter a period of restructuring that they go through before the next build out of the investment economy, and you're going through that period right now. So I think there's tremendous pessimism, which is not necessarily correct. We think India as a structural story is exceedingly strong and will do well over the next decade, and you've got to play that.